You've probably already heard about the package Tesla shareholders approved for Elon Musk that could make him a trillionaire, and may well wonder where that money will come from. I wondered what the package really says and about the company targets proposed to deliver this wealth. And here's what I found from digging deeper. I'm neither Tesla fanboy nor hater, and my goal is to give a skeptical while balanced view. But disclosure, I didn't choose a Tesla EV, although I do believe they're great and efficient vehicles, and I believe Tesla both deserves to survive as a car maker, and it's important for the world they survive as a car maker. Welcome to a One Finite Planet EV video on what this remuneration package means for both Elon Musk and Tesla. This 2025 package provides for a grant of 423.7 million shares, which, at the date the plan was announced, had a value of $190 billion. The $1 trillion figure comes from factoring in the over 6 times growth in the value of Tesla that is identified as a target in the package, which would make Tesla an $8.5 trillion company and shareholders very happy. This new package is largely designed to replace Elon's previous compensation package, proposed in 2018 and worth around $56 billion at its peak. It was voided by a Delaware judge in January 2024 due to governance concerns. If it had been fully vested, it would have granted Musk options to acquire up to 25% ownership of Tesla, including his existing stake and the new shares upon hitting performance targets. However, that package is currently not active due to ongoing litigation. Any shares awarded under that previous package reduce the number he'll get under the new package, so he doesn't get both. Both packages targeted lifting Elon Musk's total share of Tesla to around 25%. And both packages are based on 12 performance-based tranches. What makes the stated value now so much higher is the much higher target valuation for Tesla of the respective sets of tranches. The 2018 package targeted growing Tesla total value, or market cap, from $54 billion to $650 billion, while the new package targets growth from just over $1 trillion to $8.5 trillion, as shown on screen. Note that even without this package, Tesla reaching a value of $8.5 trillion would already, given his current stake, make Elon Musk a trillionaire, just as Meta or Amazon reaching a similar value would make both Zuckerberg and Bezos, with their similar percentage of their companies to what Musk currently holds. Both would be trillionaires if their companies reach 8.5 trillion market cap. This package would double Elon Musk's shareholding, giving him an extra trillion, which is why it is described as a $1 trillion pay deal. As presented to shareholders, it's about the current value of the shares and the target to grow their wealth. Either this or the old package provides similar wealth for Musk for any given share price, and the value in the future is determined by future share price. This pay package basically doubles Elon Musk's share, and so for that target, he'd see an additional trillion. While either package is worth depends entirely on the future value of Tesla stock. People seem to take whatever's laid out in the package as the highest target as definitely going to happen, but that's not necessarily so. And it's also logical that a target set out in 2018 is a lot lower than a target set out after considerable growth now in 2025. Arguably, if Elon Musk makes Tesla stock so valuable, then shareholders are getting a good deal. I feel the more interesting question is, what do Elon Musk and Tesla have to achieve for him to earn that stock and Tesla that future share price? Now, to reach these goals, does Elon deserve this or maybe need this? CEOs having stock options or shares linked to performance targets is common. What's uncommon is the value of the options at time of issue having a value anywhere near $190 billion. CEO remuneration can be in millions, but in billions? The next highest paid CEO in the world received less than 1/100th what Elon Musk is to receive, and also almost entirely as stock options. An argument for Elon Musk being granted shares of this huge value is that unlike Bezos or Zuckerberg, he wasn't allocated founder shares when Tesla began in 2003. He bought his shares. Elon Musk came on board as Tesla chairman, which is an advisory role, following February 2004 Series A funding, where he invested $6.5 million of that $7.5 million round. As the largest Series A investor, it's normal to be appointed to the board of directors as a non-executive director. And becoming chairman? That's not uncommon. Musk then also invested in multiple subsequent rounds as Tesla struggled on the brink of failure, but finally took over as the company's fourth CEO in 2008, after departure of both of the original founders earlier that year. It's a long story for another time. So Musk was not an original founder, but played an advisory role from very early, and it seems certain the company would have failed without him. And that was for the EV business. Now, Elon Musk could be seen as founder for completely new directions for Tesla, including robotaxis and humanoid robots. There's no clear answer as to whether he deserves remuneration, 100 times higher than any other CEO, and while it's pointed out that without the current package, he's not remunerated at all for his role, every CEO gets some package, just no one else gets one this big. Doesn't mean the only possibility is a package being this big or nothing at all. As to whether he needs this level of remuneration, there are suggestions. Elon Musk is in a situation where a lot of extra shares could really help. The Twitter transaction resulted in both the sale of nearly $23 billion worth of his stock and reportedly borrowings leveraging another 238 million shares, or about a third of his, at the time, 715 million shares. But that was before the 2024 court decision then voided the 2018 package as unfathomable and with concerns, including conflicts of interest. That then left him with 238, or over half of his then 410 million shares leveraged. Not in itself illegal, but not in compliance with board guidelines. And being in breach of those can lead to investigations. Yes, he could really do with getting back to at least a 2018 package number of shares. Okay, the package details. The 12 tranches are laid out in the table on screen, and key points are 423.7 million shares divided into 12 tranches, unlocked when Tesla reaches the goals. Additionally, he must remain CEO at the time each tranche is met. There's no fixed time schedule. The tranches could be reached very quickly, but there is a time limit of 10 years, so whatever hasn't been earned then expires. The focus is heavily on financial targets, market cap and EBITDA, where market cap, or market capitalization, is total value of the company on the basis of share price, and EBITDA, or earnings before interest, tax, depreciation and amortization, as explained on screen, is revenue in the form CEOs prefer, since it provides better numbers than that regulatory GAAP approved earnings. PE, or price earnings ratio, is better known than EBITDA ratio. So what would earnings be? While not necessarily the future, Tesla's last four-quarter EBITDA was $17 billion, and the earnings were $5 billion, so a ratio of 17 to 5 is possible. Tesla PE is currently at a staggering 270, and although these targets assume PE may fall, if the current EBITDA to earnings ratio is maintained, then the final tranche would still mean a PE of 70, when for reference, the current highest PE amongst Dow Jones index stocks is 26. Product targets don't even get a mention until tranche 11. It can feel like, while back in 2023, the focus was on what Tesla could do for the world, the focus has switched to a more specific: how much money can we make? As well as how high can we keep the Tesla share price relative to the amount of money we make? But what about the product targets? When I first heard the product milestones were 20 million vehicles, 1 million robots and 1 million robotaxis, I felt relieved. 20 times more vehicles than anything else. With all the "don't view Tesla as a car maker" rhetoric, it feels like there's just too little focus on the vehicles, and Tesla's contribution to the global automotive industry is significant. I don't drive a Tesla, but I respect their technology and particularly their efficiency. Model 3 and Y are at least arguably still best in their segments. No, although he played a role, I don't think Elon Musk reinvented the electric car. I have a video on the various players of that. But Tesla has introduced significant innovations. That initial relief was false. On looking further, reaching a cumulative target of 20 million vehicles by 2035. Given Tesla made almost 8 million vehicles in the last 10 years, committing to making an additional 12 million in the next 20 years, this target allows even for a fall in vehicle production. That's an average of 1.2 million per year, and last year they sold 1.7 million. Remember, it was as recent as 2023 at their Investor Day, they still confirmed a target of 20 million per year. So the targets can be met even with a small drop in vehicle sales. On target, vehicle sales aren't making any contribution to growing EBITDA from its current 17 billion level. The next target, 1 million FSD subscriptions. At current prices of $99 per month, it could add additional 12 billion to revenue. But that's hardly significant. Humanoid robots. With a price target of less than the price of a small car, sales of 1 million over 10 years is 1/10 the rate of vehicle sales. At best, it'd be like adding 10% to vehicle sales, but as a new product type, it can take time to be profitable. Tesla's first million cars didn't yet deliver any profit. That brings us to operating a fleet of 1 million robotaxis. Tesla hasn't made official projections, but those by Forbes and others range from a fleet of 1 million providing for an additional 30 to 75 billion to EBITDA. That dwarfs all other targets combined and would make robotaxis account for up to 80% of revenue and nearly 100% of the new revenue. Still, all these goals in total bring total EBITDA to around 100 billion, the financial level required by Tranche 3, but only 1/4 of the way to the final tranche. A logical possibility is each publicly declared target is only 1/4 of the internal target the company sets itself. That would allow for flexibility to shift priorities, provided total revenue doesn't fall as a result of shifting. Note that the only target required before the very last tranche is robotaxis. And given that on revenue projections it accounts for almost all new revenue, it's certainly the most important. Even 4 times the declared target for every other area wouldn't match the revenue people suggest could come from just the declared robotaxi target. Now, I'm a robotaxi skeptic. I'm not a fan of the idea people won't need to own cars, since I don't believe owning cars is all down to need. Why would people buy luxury cars, large SUVs, pickups, or off-road vehicles, none of which is likely to be offered as a robotaxi, if it's only about the need for basic transport? Is access to basic transport why people watch videos on cars? More on this in a separate video to be linked below, but if people do still manage to own cars, and those cars will also become FSD capable, then why not just use your own car's FSD so it can drive you and be your robotaxi, at least when based at home? Conclusions. So, firstly, the remuneration package is mostly a replacement for the 2018 package, and the big numbers only arise from astounding projections for the future value of Tesla stock that, based on performance and the past, could be possible. However, I'm a skeptic on Tesla having plans to achieve those goals. But then I also consider the whole market is inflated by an AI bubble right now, and I could easily be wrong on both. My biggest question is not about the ability of Tesla to execute its plan, but more about whether that plan fits with the big global picture of the next 10 years. For me, the big takeaway is that over the next period, Tesla's going to mostly be a robotaxi company. Everything else becomes almost a sideline, including producing vehicles for sales to customers.